it's kind of amazing. The Fed is. Oh, can I hopefully I can hear you now. I'm sorry. Sometimes I don't get the feedback properly on this, so hopefully you can. Oh, there we go. Can't hear it. Okay, I'm so sorry. Let me see if I can put this. Hey, can you hear me now on this one? There we go. Okay. Boy, sorry about that. Sorry about that that difficulty. I can go through the other stuff as well. So let's see if that goes up. Great. Okay. So there we go. Okay, great. I think we're back. I think we're online now, hopefully. Hopefully we're back. Sorry about that. Sorry about the sound. Still trying to get this microphone to work well, but oh well. I guess that's the case. So here we go. Let's show another question. And thanks for bearing with me here. The Fed is buying corporate debt, and House unveils $1 trillion plan. Where does the pumping end? Wow, I don't know. I don't know. It's really a strange situation out there. I mean, we're just seeing just weird stuff with all of this money coming into the market. So I can't tell you where it's going to end, but I do know that they have dedicated to buying a lot of this debt. So we're just in a situation where it will continue, and at least for right now, I think that I think that it's kind of where you want to be. You want to be long, not short, because once the stimulus is taken away, then I think we're going to have an issue. I think we're really going to have an issue with it. So, wow, it's just an amazing thing what's happening in the market now. So let's see. Any advice? And I'm going to take a question from TikTok. And the question is there any advice on INO? No real advice on INO. I know a lot of people really like this talk, but I think that there's so much better in terms of there's some other opportunities that are really better than that. It's just okay. Yeah. All right. VTIQ. Look at the 90-day cup and handle. That's a good time. Boom. I got in at 18. Awesome. Bobby, you're a rock star. You know, that's really what you're trying to look for out there. If you can, and you don't even have to have an expensive service to do this. You can do this with just Yahoo Finance. And one I like is the NASDAQ, and that'll show you the option chain, and that will give you an idea too of kind of where things are going. So any stock to keep for lookout. Well, as I let me just go over, because there was a glitch in terms of my my sound. So let's go back. I just want to show you these stocks again that I want to cover here up on the screen, and that is I want to highlight 3 stocks. The first one is Bristol Myers Squibb. I think you really should take a look at this one. It's a fairly expensive stock. It's $63.82, but it's up a dollar. It's up $1.16 today, and this is a quality stock. So, and its composite rating is 99. This isn't a moonshot stock, but I think it's one that you definitely want to take a look at. You definitely want to take a look at. So that's where you can go on that. I also am putting up on the screen, and I want you to take a quick look at this. These are basically 5 stocks that the funds are buying. And why do you want to buy where the funds are? Because they're the ones that are going to push the stocks higher. And some of these are very relatively affordable. This Collegium Pharmaceutical, it's only $22. It's up it's a 5% change today. Just tremendous. It's just really on fire. That's what you should take a look at. Also, this Switch, I like this one. $17.98 on this. It's down a little bit, but I think overall it's good. Now, this is one of my old friends. This is Novo Nordisk. Why is this such a good stock? Well, the reason this is such a good stock is because this company, along with Eli Lilly, has almost a lock on the production of insulin. So this is a very, very high margin business. It's a very protected industry, and the funds love it. As you can see, there's 254 in this. Tremendous. Really, really good. So those are the ones I kind of wanted to highlight here. And we have another question. Does it help JNK or HYG? Any ideas or options trades on them? Well, here's the problem with both of those. I love those. The Fed is supporting. Now, just for everybody out there, JNK is a high yield bond fund, as is HYG. Okay, these are the high yield bonds. Now, what the Fed has said is that they're coming in and they're actually buying these ETFs, which is absolutely amazing, because these ETFs are, basically junk bonds. What do I mean by junk bonds? This is non-investment grade bonds. These are bonds that typically have a relatively high likelihood of default. And why is that so important? Well, the reason that's so important is because many things are financed with them. Back in the day, there was a guy named Michael Milken who created junk bonds, and he basically financed the building of a lot of the big hotels in Las Vegas. So it's very interesting that the Fed is coming in and supporting this, because that means basically that we are going to looking at a situation where where the Fed is basically going to support the market at any cost, and that's very interesting, because it's quite incredible. Actually, it's really the first time in my lifetime I've ever seen this. So it's very, very tough to play in that arena, but I do think that it might be worthwhile possibly taking a look at that, because it's going to support these two ETFs, the JNK ETF and the HYG, which is absolutely amazing. So there you go. Okay, and let's see. Hi, Jim. Any thoughts on shorting? Okay, I don't. Here's the thing about shorting. I'm putting together a list of companies which I think will be excellent shorts. I think instead of W, you ought to look at Marriott, MAR. I believe that this is an excellent short candidate. And the reason I think it's such a good short candidate is because Marriott, it has a tremendous debt load. As a matter of fact, their debt percentage is like over 1,000%. It's the last time I looked, it was 1,417% of their equity, which I think is absolutely amazing. I don't actually know how you could do that, but here's the problem in the travel and leisure sector, and in particularly in the lodging sector. Nobody's traveling. And these are cash flow businesses. If you don't have the cash flow, then you can't rent the rooms. And you can't rent the rooms, you can't pay the notes. But the notes keep on coming. Now, it's true they are supporting these high yield junk bonds, because that's what the Fed is buying. That's what the YG is, but eventually the revenue isn't there. So I don't know. I don't know. Um, okay, and I have another question: is a put spread better than shorting? Well, I think so. So here's the thing. Here's the difference between shorting and a put spread. When you short, you actually borrow the shares and then sell them into the market. When you do a put spread, you basically you basically buy two different strike prices with puts. Now, interestingly enough, I actually prefer shorting, and I'll tell you why. Because when you short, the cash goes into your account in 3 days, and with the put spread, you don't have that ability because the put spread will have an expiration. So for many situations, I know this is very counterintuitive, I actually like to short the individual stocks. And when the stocks were going down, when the spider was going down in mid to late March, I was shorting the spiders every day, and I did very well doing that. So it's just your personal preference. The only thing about doing a put a bear put spread, which is I think what you're talking about, is the fact that you do have a expiration. But if you do it properly, the bear put spread can be good because you buy the underlying and then you sell the other leg, and you have a situation where you don't have any out of pocket expense. And that's really important when you're trading options, is not to have your out of pocket expense. One of my favorite trades, and I know it's a very pedestrian trade, but I have 3 of these on right now, and that is the covered call option, where you buy the underlying stock and you sell a covered call. And then what happens is as it approaches the time of expiration, if the stock is moving up, then there's a decay in the call option, and you typically win on those 70% of the time. So my advice for options are, I don't like to buy options if I have to pay for them out of my pocket. Why? Because typically when you buy options, you are in a losing position 70 to 80% of the time. And if you sell options, you're usually in a winning position. And that's just that, it's just that how it works. So I like to be a seller of options, particularly calls, but also I also like to do the puts, and that's just a cash secured put, and that's a good way to go too. So that's another way to play the market. Can you look Wayfair's charts? Okay. Well, let me see if I can do that. The Fed is still unlimited QE. Absolutely. Unemployment stimulus currently ends in August. If that happens, game over. Yeah, absolutely. Second dip. You know, I'm surprised the second dip hasn't happened yet, but it hasn't. I mean, as amazing as absolutely as amazing as that is. I mean, we have not had a second dip in the market, but you know, what do I know? I mean, I tell you, it is just incredible in terms of how it's moving. It's just a situation where it seems to be able to do no wrong. So what can I say? Let me see if I can bring up Investor's Business Daily here. I can go back. Oh, wait a minute. There we go. I was off the screen there for a second. So let me take another question. I'll dip again when the stimulus ends, and it will end. I agree with that. I do. I think it will, and I think you're absolutely right, Bobby. I think there is going to be a dip in the market, and you know, the question is when. It's always the question of when. When is that going to be? So hopefully we will see, you know, we'll see it reverse. I don't think it's healthy to be in it like it is now, because it basically causes people to go long when the market should be shorting it out. But that's how it is. So until oh, by the way, was it yeah, do you recommend options or stocks? Well, they both have a purpose. I like to sell covered calls. I like to be a seller of options and a buyer of stock. Isn't that weird? You can make a lot of money in the options market, and I definitely have over the years. But the thing is, um, when you are uh, looking looking at stocks or options, it's really they're really kind of two pieces, two sides of a coin. They're really not different. The thing about the underlying, it's kind of like the difference between owning real estate and renting real estate. You can make money by renting real estate by getting a lease on real estate and then renting it to somebody else. You definitely can do that, and that's sort of what an option is. That's what a spread is. But at the end of the day, you probably want to own the equity if it's good enough, and that's the question: is it going to be good enough? So most of my plays currently, because we're in basically a sideways moving market, are option plays, but they are covered call plays where I will buy the underlying stock and then wait for it to just go up a tiny bit, maybe 1% or 2%, and then I'll have the option that will decay and I'll make money on that. So bond rates went negative in October and December for a couple of days. Shows we shouldn't be this high. Absolutely, I agree with you. I couldn't agree with you more. It's amazing because of the low interest rates, the kind of risk that people are willing to accept in the market. That's the reason why the Fed went in, I believe, and went into the high yield bond market and started buying the bond funds because because people are moving. They're thinking that the bonds are safe, and they're matter of fact, they have almost a negative yield on some of them bonds. So you really have to be in equities. But the question is, where are you going to be in equities? Well, one place you can go if it's a rising market, and I covered this yesterday, are the Qs, the QQQ. You can you can definitely go there because that's the NASDAQ 100, and that's where the capital flows are going, at least for right now. Now, long term, though, I think we're going to see a rotation, hopefully back into some other stocks. But for right now, the action is in two areas of the market. The first area of the market is the high tech market, the Facebooks, the Microsofts, those kind of stocks. And the coming area where the funds are going to go is the biotech area, and that's why I wanted to show you 3 stocks, Bristol Myers Squibb being one of them, where the market is going to be moving next. I believe the market is going to be moving next into the healthcare and the biotech area. So this is where we want to build our watch list because this is the area of the market that the funds are going to be buying, and I think that there's some very good profit potential. So I know it's okay. Hey Jim, I've been studying the cup and handle. What is the right time to buy after the cup and handle? Very good question, by the way. For everybody out there, cup and handle, and you can just Google patterns. Cup and handle is probably the best of the best. And the way the cup and handle works is it moves up and then down, making a cup, and then it kind of retraces a little bit, kind of like a down, and then it goes up. And when it breaks the neck, what they call the neck, the left side of the cup to the right side of the cup, then it's in a upward momentum. And let me just show you this. I don't know if you can see this, but I will show you an example that I have today that has the cup and handle and the correct buy point. So let me go back here to, that's why I was so excited about Bristol Myers, because as you can see, this is the cup Here's the cup. And then this is the little handle here. You can't, I don't know if you can see on the resolution. And then when it breaks above here, like that, that's your buy point. And it has a buy zone from 63.28 up to 66.41. And this is an area that I think, based on the chart, based on the way the chart looks, and this is the cup and this is the handle, will continue higher. We want to hold the stock until it has appreciated, hopefully up to about 20%. That seems to be the magic number for some reason. I do not know why, but it is. So to make a little bit of money here on Bristol Myers, buy it at the buy point, 63.82 or thereabouts. This is definitely in the buy range, 63.28 to 66.41, and then hold it, and it should appreciate up about 20%. And if it does, then you want to start looking at possibly selling. So let's see. And we have another question here. So this is from YouTube. I'm getting a lot of people on YouTube. I'm curious to see what happens with WTI futures next week. I am interesting. I think we may have seen the bottom in terms of the WTI. Now, what is the WTI? The WTI is the West Texas Intermediate. This is the price. This is the commodity that is produced in places like the Permian Basin, where the oil is produced in the United States. The Permian Basin is one of the largest oil production areas in the world. And basically, this is the price at a place called Cushing, Oklahoma. It's just a strange place, but that's where you take delivery of the oil. So this WTI price is the price you would pay if you could go to Cushing, Oklahoma and buy it. And I believe, and of course, these prices have been reduced. The reason that they've been reduced is because Russia and Saudi Arabia, they're desperate for the cash. They are out of cash, and so that's really dating myself here. But there used to be gas wars. Well, essentially, we've had one in the oil business, and that is everybody's dropped their shorts, and we have a very, very cheap oil. But I do believe oil's going to firm. When the U.S. opens back up, people are going to have to drive around. And even though I love Tesla as a company, I don't think that everybody's going to stop driving cars that have gasoline. I just don't, at least for a while. Look, just Google cup and handle pattern, and you will see it, and it's really, really good. Now let's see another from TikTok. When is the next when the next wave comes? There's not the Fed. Yeah, I don't know if the Fed can control this. This is such a weird time. I mean, what has happened with this drop in demand is we've had a very, very unusual event, and that is a deflationary event. For most of my lifetime, and matter of fact, many other people's lifetime, we've been in an inflationary situation where things have actually gone up in price. Well, without demand for hotels and cars and that kind of and that kind of thing, we've had a deflationary shock, which means that all of a sudden people stopped buying gasoline because they couldn't drive around. It's amazing. So of course, the price went down. Now, deflation is not a very good thing because usually it's followed by a lot of inflation. Because how would I know that? Well, if you look at the economy of our deflationary periods, and I think unfortunately that's what we're in. The Fed is trying to mitigate this problem by pumping all of this liquidity into the market. Well, liquidity has to go somewhere, and eventually it will be shown in the general economy. But at first, it's going to go into the markets. Why? Because that's the only place that's big enough to accept all of this other money. So I think by the end of the summer, if the economy recovers, we're likely to see a little bit of hyperinflation. As a matter of fact, we're already starting to see it in the grocery stores. I don't know if you've gone in and taken a look around to try to buy beef or anything like that. It's kind of expensive. It's really interesting. It's gone up quite a bit. So there you go. I think we're going to have, but for right now, we're not in an inflationary period. So we don't want to take that in mind. I mean, a lot of people are going to buy gold right now, and they're going to be very disappointed because it's going to move back. But I think once we get to an inflationary period, I think towards the end of the summer, then I think those kind of investments are going to be real good. Two stocks that you ought to look at, because I think they'll do very well in the coming year. One of them is a company called Kirkland Lake Gold. It's KL. It's a gold miner. It's a Canadian gold miner, but most of their production is in Australia. And 20, 30 years ago, most of the production for gold was in South Africa. That's changed. Most of the new production for gold these days is in Australia. And so that's something you ought to look at. Let's see. Another question here. Wow, I'm getting all these nice questions. The House unveiled a $3 billion COVID relief. Ouch. Okay. Well, we may have inflation a lot sooner than you think, because that's a ton. $3 billion. I can't even hardly imagine that. That's so much. I mean, that's sort of like Zimbabwe style. That's going to cause some Zimbabwe style inflation. Definitely take a look at the gold miners, the KL, and then also take a look at a company called Franklin Nevada, FNV. That's another one you want to look at. Why? Because these are companies that have interest in gold mining, and there's going to be, I think, more demand for gold. Not right now, though. So it's a kind of a watch list thing. Right now, we have deflation in the market. We have deflation in the market. So that's something that you can't really predict. But put those on your watch list, because if we do get some inflation, which we will, those are going to be good stocks. Hitachi writes in, and I really appreciate your comments so much. Hitachi, thanks for watching me on YouTube. ExxonMobil or Chevron? Well, guess what? They're both great companies, but in terms of quality of balance sheet, they both have very strong balance sheets. So it's kind of like, Coke or Pepsi here. They're both great companies. For value, I would go with ExxonMobil over Chevron, only because Chevron is a little bit higher. But they're both tremendous companies. They're not going to go out of business, even if the oil business has some trouble. So I would look at ExxonMobil because it is trading to a little bit of a discount to Chevron. This is one of the few times, and normally I don't say this. Normally I like to buy the most expensive stock in the best sector. Okay, that's typically how I've done it over the years, and it's done very well. I've been buying quality, but these are both quality companies. ExxonMobil is a quality company. Chevron's a quality company. So in this case, in this market, just now, I would look at possibly buying ExxonMobil over Chevron, but they're both great companies. So I just want to say that. Also look at BP, but I think you can't go wrong with ExxonMobil over the next year or so. I really don't believe you can. Let's see. Any in Dell's Trading? What is CFS? Well, no, actually, we're all independent here at Dell's Trading Floor. It's just basically independent traders that like to trade stocks and options. And we're right here in Dallas. We're actually on Preston Road. Unfortunately, the building that we're in right now, it's closed to the general public, but hopefully we'll be open soon. It's right on Preston Road. If you're familiar with Dallas at all, you just drive up Preston Road, and it's at the corner of Preston and McCollum. That's the name of the street, McCollum, and it's a building that has a kind of a weird. It's a little three-story building, and we're on the third floor. So the address, if you're interested, is 17920 Preston. So there you go. Let's see. Oh, did you say yes to the CFAs? Oh, well, no, we don't really have any CFAs here. I'm not a CFA. I do have an MBA, but that was a long time ago. No, we don't have any CFAs. But if you are a CFA, if you're very interested in talking with you, we have colo space here as well for people that are in the advising business, and I definitely would love to talk to you if you'd like. The number here at Accredited Investors Marketing, which is my little company, is 214-233-5087. And that's the number you can call. That's for Dallas Trading Floor. Just put that up, and that's our mailing list. So yeah, if you're in Dallas, we have a number of financial professionals here in this building, and we're located basically right on the Collin County line. So it's very convenient if you're in North Dallas. So let's see. I'm doing level. Oh, you're doing level 3. Excellent. Okay. What is a level 3 authorization? Well, when you trade stocks or options, there are 3 levels of capability, and they let you do various things. There is a level 1, which basically is the level that you can use where you can't really access. You can write covered calls, but you can't really access any margin accounts. Level 2 lets you access margin, which is very helpful if you're trading because it allows you to get in and out of positions before everything settles. Now, what do I mean by settle? Well, if you buy stocks, you have to pay for them in 3 days. But if you buy options, you have to pay for them in 1 day. So sometimes I've been in situations where I've bought stocks and then I have sold them before I have to pay for them. So they don't really like that as much. That's called day trading. So typically to have that capability, you have to have a little bit more credit, and that typically comes with a higher level. So I would recommend trying to get level 3 access. And basically what they do is they send you a questionnaire and you basically answer how many years of experience you have. And basically they're just trying to keep the newbies from making any money. I think sometimes you can get into trouble with you can definitely get into trouble with margin and that kind of thing. But it's a good thing to have if you're gonna trade seriously. So let's see. Go back here. Is making people money right now? Well, I'm hoping I'm trying to make people money because that's my goal here. If I can make people money, I would feel fabulous. I have traded stocks and options now for almost 20 years, and it's been a great little job. I mean, it's kind of portable. You can go around and if you know kind of where the market is going, you can make money just basically week in, week out. Now, it's not totally easy. I mean, if it was, everyone would be rich, right? But believe me, learning how to trade stocks and options is a very good life skill because it's a business that you don't have to have a franchise for, and yet you could trade with the very biggest and best companies. So it's definitely something worth looking at. Uber acquisition of Grub. Yeah, this is really interesting. Thank you for this question. I really appreciate this question. Uber, here's the problem with Uber, and I hope I'm not hurting anyone's feelings by saying this, but Uber, do you know that Uber now actually loses money on every ride? So they have a lot of market share. Their stock is doing really well, but they lose money. Interestingly enough, Grubhub makes money. It's kind of like in the airline business, the real money is made by the freight companies, not by the passenger companies. Wow, that's weird, but that's the way it is. So Uber needs to stay alive because if Uber continues on the path that it's on, it probably will go out of business. And I know I'm going to get some haters for this, but they are actually losing money. Now, why do I know this? Well, many years ago in New York City, you could drive a taxi cab, and you could drive a taxi cab. Just anybody could do it. You just got a car and you just drove around. But they found that what happened in this business was that the taxi cabs ended up competing with each other, and they all became losers. So people were fighting with each other for fares, and then they became losers. It was essentially a race to the bottom. And that's the problem with Uber. Is in order to stay number one, they can have continuously lowered their prices, which means they don't have pricing power. Everybody's after them. I mean, all the taxi cab people, they all are trying to cut the cost, and so it's a kind of a bad situation unless they can control the number of people in the industry, which I don't think is going to happen. It's going to be a problem for Uber in the future. That's why they're trying to buy Grubhub, because Grubhub is profitable. Grubhub allows small restaurants to basically have a delivery fleet on an as-needed basis instead of having to have drivers like Domino's does and those kind of companies. A regular, just normal restaurant can have that capability, and they don't really. It's a pay-as-you-go model. So this is the reason Uber wants to buy them. Now, do I think that the shares of Grubhub will definitely appreciate on this, but I think overall, long term, I don't think this is a sustainable model. So this is part of the reason I'm not in Uber. I just don't think long term it has legs. But I think short term it's a tradable stock. Absolutely. Let's see. Does QE cause inflation? Very good question. Thank you, Malcolm. Appreciate that. Absolutely it does. As a matter of fact, that's what the government is trying to do right now. And say, why do they want inflation? Why does anybody want inflation? That's so bad. We won't want that inflation. Well, the reason the government wants the inflation is because we have a very, very large debt in this country. We have indebted basically everybody in this country and then their children. So how do we get rid of the debt? Well, we could produce our way out of that, but I don't think that's going to happen. The way governments always get rid of their debt is to print money and create inflation. And so QE is all about creating inflation to get rid of debt. So eventually that's going to come home to roost. Right now, the problem in the market isn't inflation, though. Right now, it's lack of demand. One of the problems that technology has, we are transforming our society into a digital society. And one of the problems with the digital society is the digital society is very, very, very disinflationary. What do I mean by that? Well, think of it. Think of a bank. 20, 30 years ago, there was no apps and basically people, you couldn't bank online. You had to go into each individual branch. Each individual branch employed maybe 10, 12 people, and they all had salaries. Think of it today. I don't hardly go into my bank branch at all. I do it all online. So I have a bunch of IT people that may or may not be in this country. They may be in India. And I'm banking with the bank, but instead of having to have maybe 10,000 people, the bank only needs maybe 500 people. That's very, very disinflationary. So because of this change, this digital change in society, I think that is one of the biggest trends. The government needs to have inflation in the market. That's why they're pumping so much money into the economy, because they're afraid that most people will not be able to earn a living. That's why there's all this talk of the universal wage, because they're realizing, unfortunately, the government is realizing that in terms of an economic sense, many people in our society have no way to earn money. They have no value add. So that is the reason why they're pumping all this money into the economy. They're trying to inflate away the debts. And they're also trying to desperately redistribute wealth because so many people in this country cannot earn a living. They have no value add. They can't manufacture anything. They only are consumers. That's it. They have no availability. Now, there's some people, though, that are incredibly valuable to the economy. For instance, a database programmer. They're very, very valuable to the economy. That's why, that's why they make the kind of money that they make. But most people, unfortunately, in our society today they don't know how to make money. They don't own any assets. So that's why you have this universal income talk, and you also have all of this money being pushed into the economy. Anyways, so QE is all about inflation. It's about reigniting inflation that helps get rid of the government debt, and it also helps alleviate some of the problem. The people that are going to get killed when this debt bomb explodes, and it will, are the people that have savings. It's going to be very bad to have savings. But right now, we're in deflation. So cash is king right now, but it will flip. And when it does, then things like gold, then things like will become bigger. I am not a gold bug because I don't believe in it. But when inflation comes in, and I think that we're going to looking at that possibly by the end of the summer when everything opens up, I think, it's time to start looking at some of those gold stocks. You can probably make some money. Anyways, let me see if I have any other questions here. Let's see. Did you say yes to CFA? No. Okay. That was another question. Okay. Pay us to consume. Absolutely. No. This is actually true. This is actually true. Here's why the situation with China is such a big deal. China, for 20 years, has exported a lot of its deflation to the United States. Japan did the same thing. In order to keep people working, and that's the most important thing in China, they basically created a situation where they needed to produce a lot of goods. So what did? They subsidized the export of those goods primarily to the United States. And of course, the United States got rid of all of its manufacturing, and the people at the low end of the totem pole, they got screwed, basically. Unfortunately, I hate to say it. You know, the factories closed, and they became people that could not earn a living. Why? Because they couldn't add value. They had the normal ways that they had added value working in a factory, that had ended, and they didn't have the right skills. Not that they were bad people. I mean, I think we get confused in this country. We confuse, you know, whether a person is good or bad by whether they can earn something in economically. But that's what happened. We have, unfortunately, in this country, because we deindustrialized, we have a large number of people in this country that are very good people, but they have they don't have the ability to make a living. And that is a problem. So the government is going to put money into their hands and have them consume. And that's exactly what's happening right now. So I hope I didn't. See, I'll get off my soapbox now, and I don't want to be sound like a kook. Anyways, let's see, Bobby. It's been by far my best talk. I wish I had more of it. Absolutely. What do you mean? What do you mean the export deflation? Okay, this is something that they will not tell you in the economics classes. What causes deflation? Well, deflation is caused when the value of cash appreciates relative to what it can buy. Right now, the value of cash is increasing in terms of what it can buy. This is a very bad situation for an economy, because if that is the truth, if that is happening, people don't want to consume into the future because things are going to be cheaper. So why spend today, right? That's deflation. That's what we have in the economy. People are like, well, I don't want to buy a house, or I don't want to buy a car because it might be cheaper next month. So why would I do that? That's a problem, because if people don't buy those things, you see, our economy is 70% consumption. So if they don't consume, guess what? And with this COVID-19 virus thing, it's caused a drop in consumption even more. People are staying home. They're not going out to restaurants. Well, in a place like New York City, that's disaster, because so many people work in restaurants. Yeah, I mean, that's what they do. They work in restaurants. So if nobody's going out to restaurants, there's no work. Most of the restaurants are going to lay off most of their people, and that's going to happen in the next few months. And it's tragedy, absolute tragedy. But that's what's going to happen. And when they get this drop in demand, that is what causes deflation. And we are in a situation where we're in danger of having a deflation. This is what happened in 1929 when, of course, I wasn't around then, but this is what happened in 1929. There was lots of deflation, and that's what caused the Great Depression. It took World War II in order to get enough consumption to bring us out of this deflationary spiral. Right now, we're sort of in a deflationary spiral. And a lot of it's exacerbated by two things. One of them is that many of the white-collar jobs are being replaced with software. That's number one. And number two, almost all of the manufacturing at the low end, most of it has left this country. So there's no way for a lot of people to earn money. Therefore, people are trying to crowd into the safe haven, which has been the government, the government sector jobs. But if tax receipts go down, the government sector jobs won't be good either. At the end of the summer, you're going to start to see many places start to lay off people in the government sector. It's already starting here in Dallas, and it will be more intense in places like Illinois and California and New York, because they have a larger percentage of their population that are in those kind of jobs. And if they don't have the taxes to support them, they will have to lay off those people. So we have a disinflation, de-inflation problem. The Fed is trying to remedy that. And the way they're trying to remedy that is they're trying to give support to everybody. They're trying to give, for instance, that's why they went into the market and bought up the high yield bonds, because these high yield bonds typically are more risky, and they tend to finance consumption that may or may not. For instance, our construction sector right now is overbuilt in many areas. It's overbuilt shopping centers, it's overbuilt office buildings, but yet it continues to go. This is financed by the high yield bonds. That's why the Fed came in to buy those, because people were saying, well, there's no chance that these companies are going to make any money. That's another thing. We have deflation coming in the airline sector. And the reason we have the deflation coming in the airline sector is because people are not going to travel as much, because if you have to sit next to somebody that may have COVID-19, you might not do it. You might only travel if it absolutely was necessary. So the drop in the demand there means that less production. You can already see this in the price of Boeing stock. So we have not an inflation problem. If people tell you we have an inflation problem, be very careful about taking that advice, because I don't think it's right. We have a deflation problem right now. And the problem is, if you have enough deflation, it causes problems like wars and that kind of thing, which kickstart the economy to increase consumption. So, I mean, that's a danger. So here I am. I'm being doom and gloom, and I'm not a doom and gloom person. So, anyways, do you mean okay? Let's see. All right. You think it's just fine? Okay. Bengali, is it in terms of swinging to an ETF like SPXL 2X? I wouldn't be in a 2X right now. What we mean by 2X is a 2X fund. Basically, what they do is that they leverage. They use leverage to, for instance, a good example of a 3X fund is the SQQQ, and basically what they do is that they take a position, short positions that typically amplify. So I wouldn't be in a leveraged fund right now, because I still don't really know where the market is moving. So at least hold off on that for right now. Well, it's been almost an entire hour. I've yammered on again, and thank you so much for taking a look. And hopefully, I'm going to start a service, hopefully, for alerts and things to do when the market changes. And you might want to take a look at that. Might want to avail yourself of that. That's Dallas Trading Floor, www.dallastradingfloor.com, and just put something in the comment section. I really appreciate it. Oh, and I have last comment here. Just want to show this. Goldman Sachs market will drop. Yeah, okay, there you go. There you go. I believe this. This makes sense. I really like your comments, Market Trader. Really appreciate it. This is watching on Periscope. I think the market will retreat for a lot of reasons. I think it's being pumped up right now. So I do see that is potentially by the end of the by the end of the year. So I do see a declining market. So, but be very careful. It's not starting to decline yet. But when the market changes, that's when we're going to want to start shorting. I'm trying to put together a nice shorting list. I have a number of candidates on there. One of the biggest ones is Marriott right now for me. I'm looking for very high debt companies that I think won't fare as well in this downturn. And there's a lot of money to be made in shorting. And I definitely have made some in the past. So stay tuned for that. I'm going to be going into more of that towards the end of the week. Thanks for everybody watching. I always appreciate doing this show. It's a pleasure to be here to see your questions, and see you tomorrow at the same time. So bye for now.